Hello learners, welcome to today's class. I am Kezia Wanjiko. Our lesson today is on public finance and taxation, and we shall focus on value added tax, VAT. We're going to look at VAT from different subtopics, and you're going to borrow a lot from previous lessons that we've had. So we're going to look at 1, the meaning of VAT. 2, reasons, purpose or reason, or in other words, you're going to answer the question why VAT. Then you're going to look at the meaning of value. Now, value-added tax is governed by the Kenyan laws under the VAT Act, Chapter 476 of the laws of Kenya. So we're going to be referring from time and again to VAT Act. According to the Act, value-added tax is a tax on sales that is collected by an agent of the government. Now, what we mean by that is we're going to first flash back to something that we did, which was the meaning of direct and indirect taxes. Under classification of taxes, VAT was classified as an indirect tax, implying that as an indirect tax, 1, its impact is on one person and its incidence is on another person, and 2, it is included in products' prices. Now, under the same topic, we said that when a product includes a tax, the taxpayer may not necessarily know that they are actually paying tax. So, which is something about sensitization of the taxpayers. Then in impact and incidence, if you remember, we said an impact refers to the first point of contact between a tax and a taxpayer. So when we say that impact of VAT is on one person and incidence on another person, what it means is that the first person who bears the money burden of taxation is not the final one who pays that tax. For example, you're going to be looking at an example. So normally, because of the inclusion in the product prices, VAT will always be paid by the final consumer. So let's look at the purpose of VAT. Now, we're going to borrow from the reasons why the government levies taxes. The primary reason for taxation is usually to raise revenue. Now, if we look at the economic pyramid in Kenya, you find that this given being the pyramid, we're going to have very many people in that class, then fewer in the middle class, and then in the upper class. So VAT normally focuses at the base of the economic pyramid. This is why we have very many people. So Kenya, being a developing country, implies that most of the population is actually in the lower economic level. So when, therefore, you tax VAT and you focus on this level of the population, then it becomes highly productive. Productivity is a canon that was covered in taxation, which basically means that when a tax is productive, the yield is high. So you're going to have a tax, but the money that comes in forms of revenue is very high. That is the main reason why we have VAT, that we are a developing country, and as such, most of the population is under the lower income earners, and VAT will focus on the low income, meaning that since that is where a concentration of the population is, we're going to have a lot of yield. So that answers the reason why VAT. The meaning of value. Now, value added tax, under tax base, we said that the tax base is the item with reference to which tax is going to be charged. The tax base for VAT is value added. Now, we're going to borrow something from economics. In economics, value is equated to utility. So you said in economics, utility is the ability of a product to satisfy human wants. So we're going to equate value with utility. So you're going to borrow from that, and then we'll discuss the various forms or types of utilities that you have so that you can derive how an organization, how a business creates value on which we're going to levy value-added tax. Now, utility, you have four things. There was form utility, there was place, there was time, and there was possession. Form utility is created when you change the physical form of a product. For example, you take raw materials, you process that, and the output is a finished product. So you have changed the physical form of that product. You take paper, process that into tissue. You've changed the form. Then, place utility, it occurs when you bridge the geographical gap between the place of manufacturing and the place of consumption. That simply means that you are going to transport the goods from where they have been manufactured to the place of consumption. For example, if the goods are manufactured in Mombasa and the consumers need them in Nairobi, that is place utility. So this is through manufacturing. This one is through transportation. Time utility is created, or it occurs when you bridge the time gap between the time of production and the time of consumption. For example, we know that most of the products have an expiry date, meaning that there is a time period between when that product was produced and when the product is supposed to have been consumed. So when you bridge that, the time gap between the time of production and the time of consumption, we say that you have created time utility. And you do that through warehousing or storage. Possession utility occurs when you transfer ownership. When you sell from one person to the other, that is when you create possession utility. These sales. So back to the meaning of value. So when we equate value to utility, we're saying every time a firm does any of these ones, then it is creating value. And the result is, on the value created, we shall take a proportion of the value to be value-added tax. You remember that in taxation, tax was defined as a proportion of somebody's wealth or a person's wealth that is willingly transferred to the state. So you pay a proportion of your wealth to the state, we call that taxation. So you say value-added tax, you're saying out of the value that you've created through manufacturing or transportation or warehousing or through a sale transaction, the value that you've created, a proportion of that will be what you pay as VAT to KRA. Now, let's get an illustration on that. We're going to assume that we have a manufacturer. So, manufacturer who sells to a wholesaler who sells to a retailer who will sell to a consumer. So the manufacturer, for example, the cost of production is 100,000. Sells to the wholesaler at 180,000. The wholesaler stores those goods, breaks the bulk on those goods, packs, rebrands, and sells to the retailer at, let's say, 250,000. The retailer further breaks the bulk, stores the goods, transports from the wholesaler to his premises, and later sells to the customer at 300,000. Now, we have said under impact and incidence that the impact of VAT is on one person and the incidence is on another person. So that means, given that illustration, the impact, the first person who bears the responsibility of paying VAT to KRA is going to be the manufacturer. Then sells to the wholesaler. So we want to compute how much, what is the value that is added. And remember, this value, other than the manufacturer, is through the place, the time, and possession. So the wholesaler, again, stores the goods, breaks the bulk on those goods, and then later sells to the retailer, who may, for example, further break the bulk, store, transport, and then sell to the consumer. So we're going to get the differences in prices here, which is going to be the value that has been added. So the difference in prices here is going to be 100 minus 180 minus 100. This is 80,000. Then here, 250 minus 180, that is 70,000. Then here, 300 minus 250, this is 50,000. Now we said tax is a proportion of wealth that is given up to KRA. The current rate of VAT is 16%. So it's saying on the value 80,000, 70,000, and 50,000 that is created by each of the intermediaries, we are going to charge 16%. So 16%, we will have that as 80,000 times 16%. That gives us 12,800. Then we take 16% of 70,000, 11,200, and 16% of 50,000, 8,000. So in this illustration, we have taken the chain of distribution or the supply chain. These are the prices. At each point in the chain, they add value, and that value increases the prices. So the value is the wholesaler at 80, the retailer at 70, and the consumer at 50. Now, 16%, we said, is the proportion of the value added that is supposed to be given up as tax. So we've computed 16% of 80, 16% of 70, and 16% of 50 to give us these values. Now, what happens in a business is that for VAT to be charged, you've got to be a business. You don't pay VAT when you are an individual. That means you and I cannot be charged, cannot pay VAT, although when you buy products, we will pay to an agent of KRA. So what we shall do is we will go to registration of VAT. Now, in registration, VAT registration is guided by the Act. Currently, registration is done online. So you go to the KRA portal, www.kra.go.ke/portal. And you do that through prescribed application form for VAT. Now, there are two types of registration, as you're going to see, which are so you're dealing with registration, two types, voluntary and compulsory. Now, compulsory registration is for every person, and a person here is the legal description of a person, not just the natural flesh and blood person. So it could be a business, a sole proprietorship, a partnership, a company. So any person who intends to supply means you are selling, taxable goods, and whose turnover in a given period of 12 months, not a calendar year, 12 months is supposed to be more than 5 million. So we're going to call that 5 million figure threshold turnover. So when you expect you're a business and you know over the past 12 months, so you start, for example, if it is May, work back 12 months. If the current month is April, work back 12 months, September, work back 12 months, like that. You don't take the calendar year. So if over the past 12 months, you have made taxable supplies and the total is 5 million or more, meaning that you'll be accumulating for month 1, 2, 3, 4, 5, up to the 12th month. Then, upon reaching the 5 million mark, the threshold turnover, you shall apply for registration within 30 days of getting the threshold turnover. That is what you're calling compulsory registration. So you register within 30 days when your taxable turnover exceeds 5 million shillings currently, or when you're expecting to make supplies that are worth that much. That means this will apply to a current business and to a business that is starting as we speak. So if you start a business today and you're foreseeing that in your sales projections you'll make sales worth 5 million and above in the next 12 months, you can seek registration today. So this compulsory registration should be made within 30 days of attaining the threshold turnover. And remember, you're making this on the prescribed form by KRA. The other process of registration is voluntary registration. Voluntary registration is for people or persons who've not reached the 5 million threshold turnover, but they feel that they would want to be included in the VAT. So they make an application to the Department of Domestic Taxes, or, so this is through applying to the Commissioner of Domestic Taxes or Domestic Taxes Department, and you explain the reasons why you feel that you need to be included in VAT as a business. And then after that, the commissioner, upon receiving whichever type of application, is going to go through that application. And once they're done and they're satisfied that you ought to be registered, you will be registered. When you're registered, you're going to receive a registration certificate from KRA. That registration certificate has a serial number. That serial number must appear in every transaction that you make. And the registration certificate must be displayed conspicuously in the place of business. That simply means that when someone walks into your business, they will be able to see the registration certificate. And you can even try that. You get into a business like a supermarket. As you get in, there is especially the customer service area. They have all the legal requirements. So they'll have the city council licenses, they will have whatever is required, and in addition to that, they will have a VAT registration certificate. So once you get registered and you get the certificate from the commissioner, and you fail to display the certificate, that is an offense in VAT. And once you're discovered, or once an officer of VAT comes to your premises and they don't see the VAT registration certificate conspicuously displayed somewhere that they can see, they are going to charge you an instant default penalty of 20,000. Now, the process is, we can go through it again. You go to KRA portal, you get the prescribed form, and then you fill in the details. Once the commissioner receives your application, the commissioner goes through the application, and once he is satisfied that you ought to be registered, he's going to issue you with a VAT registration certificate. Now, there's a third way. You see, these two ways is where this will originate from the taxpayer, from the business. The third way is where you're making taxable supplies. You know that you ought to be registered for VAT, but you're yet to register for VAT. So if the Commissioner of Domestic Taxes comes across such information, he is going to register you for VAT. And that registration, since you did not declare when you became taxable, it's going to be retrogressive. So if he sends the officers and they find that you, for example, the current month is whichever month, let's say May, and you attained the threshold turnover last year, let's say in November, the registration that you're going to have will take effect November. That is what retrogressive means. From the date you ought to have registered, but you failed to register. So in addition to a penalty, you're going to be registered, and it's going to work backwards, meaning that you will pay tax. Now, when the commissioner does that, he is going to ensure, or he's supposed to ensure that you actually follow through and you pay your taxes. But mainly, since we are taking that businesses are law abiding, upon attaining threshold turnover, you shall register for VAT. We want to look at the impact of registering for VAT. So the implication of registration. The first implication is that the registration certificate appoints you as an agent of KRA. That means the government is appointing you as a tax agent who's able to collect tax on behalf of the government and remit the tax that you have collected. Meaning that if you collect VAT and you fail to pay, to remit it to KRA, then that is going to be an offense. So that is the first implication. The other implication is that, so here you have VAT registration certificate, prominently displayed. The other implication is that the serial number, like we had said, of the VAT certificate must appear or must be printed in every tax invoice. Then you're able to charge VAT, on taxable supplies, and you're able to recover VAT on input from VAT collected. Then every month you must submit a VAT return to the commissioner. of domestic taxes. Those are the implications. Now, anytime you fail to do any of the following, that is an offense that will attract a penalty and a fine. Now, we're going to read from the Act on what your rights are as a registered person. So once you get the registration and KRA legally appoints you as one of their agents, the rights that you have is, we are reading from the Act. So under the VAT Act, a registered taxpayer has the right to deduct allowable input tax, get a refund where input tax exceeds output tax. We will see that later, what it means to have input tax, what it means to have output tax. Get relief for stock in trade at the time of registration. Now, what that means is, now let's take the scenario where you are accumulating your sales over time, over a period of 12 months, to ensure that once you hit the 5 million threshold turnover, you're able to register within 30 days. We've seen that that is the law. So in that case, if you register today, there is the stock that you have in trade today as at the date of registration. Now, when KRA, or when you receive the registration, the certificate will give the effective date. So what you're supposed to do when you receive the certificate, you immediately do a stock take for everything that you have, the inventory that you have at the shop. The reason is that going forward, you need to claim the input VAT that you had paid on that stock, because that is what you will later sell. And that is what this point says, that you are entitled to get relief of VAT held get relief for stock in trade at the time of registration. So you get registered, you receive your registration number, your registration certificate, you do a stock take, and you value your stock, because you are supposed to claim all the input VAT you've paid on that stock against the output VAT that you shall collect when you sell the stock to the customers. The next part of right is that you get relief of VAT held in exempt supplies which have become taxable. Now, we will see this later, the differences between exempt supplies and the taxable supplies and the types of supplies. But what generally it means is that for some of the sales that you are making, some products do not attract VAT. That is what we call an exempt supply. But others attract VAT. That is a taxable supply. So because tax is dynamic, and you said it's guided by the Act, and the Act gets revised from time to time, you find that sometimes the stock that you may have may be exempt, but now it has become taxable. For example, maize in Kenya for millers used to be, the maize meal used to be exempt. But then at some point in 2017, it was declared zero rated. So that is what we mean. It is exempt now. It was not supposed to be under VAT, but now the Act has been revised and it has been brought into the VAT bracket, turning it from exempt to taxable. The next right is the right to get relief or refund on capital goods, including buildings, acquired or put up within 12 months prior to the date of registration. The next, the right to get a refund for bad debts. We're going to see much later that for VAT purposes, the treatment of bad debts is different from the way we treat bad debts in financial accounting. Now, in financial accounting, once a debtor proves that they are not paying, and that is after trying to collect for a number of times, reminding them, sending letters and all that, once you are satisfied that they will not pay, in financial accounting, you write off that debt. But for tax purposes, a debt is written off at the earlier of two things. So the first thing is the debtor has been declared bankrupt, and therefore you have proof that they are declared bankrupt because the court issues a statement to that effect. And two, that debt has taken more than 3 years since you sold, and you have tried to collect the debt, but you have not been successful. So those are the two conditions, that for a debt to be declared bad under VAT, for it to be written off for VAT purposes, the debtor must have been declared bankrupt, or the debt must have 3 years must have expired since the time that you sold. So the earlier of those two, you declare it a bad debt. Then the right to get a refund of tax paid in error. Now when you talk of tax paid in error, it means you paid tax to KRA. Remember, again, tax is a compulsory contribution. You must pay it. So you paid VAT to KRA, but there was an error, maybe computational. As you are computing, you used the wrong rates, or you overstated. There was something that led to an error. So you get the tax that you paid in error, the difference between what you paid and what you should have paid. Then defer payments of tax due to a date not later than 20th day of the month succeeding that in which tax is charged. We're going to see later that in VAT, the time period for payment is rather regular because it is every other month. So you pay VAT per month. And when you talk of the 20th day, it means that, for example, the VAT that is payable for the month of January shall be submitted to KRA by February 20th. If it is for the month of October, it should be submitted to KRA by the month of November 20th. Like that, like every other 20th. So on 20th, you pay VAT for the previous month. Failure to do that, an offense, it attracts penalty, and it has interest. Then the next right is to object to disputed assessment. Now, disputed assessment is when you fail to make a return. Simply you fail to tell the commissioner how much you've collected over a given month, and the commissioner does that on your behalf. So he issues you with an assessment, and you feel that whatever the commissioner issues you with, it's overstated. So you dispute it or you object it. So the point reads, object disputed assessment. So you have a right that when you feel that you have been overtaxed by the commissioner or by an assessment coming from the commissioner, you have a right to object to that and state, of course, the reasons why you are objecting. Then request for reconsideration of an assessment, the same thing. Appeal to the tribunal. We're going to see much later that there is a tax tribunal in every tax district. Now, once as a taxpayer, you get a PIN, that is personal identification number from KRA. The PIN certificate will show you your tax district. So anytime you have an issue, a tax-related issue, you're always going to quote that PIN, and you're going to, the first point you approach is your tax district. Next, you have a right to demand that every authorized visiting officer identify himself or herself. That is going to be through the IDs, their identification cards from KRA. Then have free access to the commissioner or any other authorized officer. When you need help, you have free access to the commissioner, meaning that you shouldn't pay for it, and it should not be a very long process for you to be able to get communication from the commissioner. Then expect that information obtained in the course of duty by the VAT officers shall be treated in confidence. And also expect minimum interference. Now, when the KRA officers are to come to the business, they should always do so within business hours. So it should not be outside of business hours. They should not come at night. They should not come outside. Normally 8 to 5, they will come in and they will have to identify themselves so that you can have proof that they are genuine and they have been sent by the commissioner. Then the next right, expect to be treated fairly and with equity. You remember that in taxation, the most common principle and the most important principle of taxation is equity or justice in taxation. So in all dealings with the commissioner, the taxpayer is to expect the commissioner to always treat them fairly. The last one is the right to be given assistance in understanding legal obligations. That is, if there is any part of the act that you do, the VAT act that you do not understand, then you can always seek clarification from the commissioner. Now that takes us to the obligations of a taxpayer. Now, you have been registered. We have talked, we've discussed the rights that you have as a registered person. There are those things that you must do, or the obligations that you must have as a taxpayer, and that is again defined by the Act. So we read the Act again. So the obligations include the obligation to apply for registration. We had explained that earlier. Failure to do that, you attract a penalty. Then the second one, charge VAT at the right rate on all taxable supplies. This is supposing that by the time you're getting registered, you will have the knowledge of VAT, or you will internalize the Act. If not that, you will hire someone who has an understanding of the Act and is able to apply the right rate. But we've said, should there be an error in your computations, you can always apply for a relief of error or mistake. The third obligation is to pay tax to registered suppliers. Now, for VAT purposes, you only pay tax to registered suppliers. And we've said the basis of registration is they have applied and the commissioner has gone through their document, he's issued the registration, and once you get to their premises, you will be able to see the VAT registration certificate. So if a supplier is not registered, that means they gave you a tax invoice, or what in layman we call receipt, that does not have a serial number that shows the VAT registration number or the certificate number and the serial number of that tax invoice and the serial number of the machine that has been used to print that invoice, then you don't pay VAT to them because they are not authorized by KRA to collect VAT on behalf of the government. The next obligation is to install and use an electronic tax register. Now, an ETR, electronic tax register, is a device that is specifically been devised for KRA and for VAT purposes. So what it does is that it has a memory, and that memory is able to keep that or the details for at least 5 years, and you are not able to erase the memory. So that is what an ETR does. So every invoice or every receipt for a vatable supply should be printed from an ETR device or an electronic tax register. That is a requirement by law. If failure to do that, again, you attract penalties and fines. Then the next obligation is to issue a tax invoice for every supply made by him. Then submit monthly returns to Domestic Taxes Department. You said you pay VAT by the 20th day of the month following the month of sale or the month of supply. Then pay to the commissioner any amount he may have charged on the invoice by error, and keep full and true records written and retained for 5 years. Now, the records must be kept in Kenya shillings because you are accounting for VAT in Kenya, and they must be in English, not any other language. So it's in English, Kenya shillings, and they are to be kept for a minimum of 5 years. We're going to see the records that you are supposed to keep in our later discussions. Then to avail records to authorized officers of the department at a reasonable time for inspection. You said basically that is going to be business hours. Then to produce for examination by the commissioner or an authorized officer any records, books of accounts, balance sheets or other documents as may be required. So you furnish the commissioner with any documents regarding your business that they may require. And these may be required retrogressively. So it does not have to be for the month that you are on. Remember I said you're supposed to keep those records for at least 5 years. So within any time within 5 years, the commissioner can send his officers to your premises, and the expectation is that you already have those records in place and you are going to produce them. Failure to do that, again, an offense. Second last, allow an authorized officer to enter premises upon which he carries on business. So they said once an officer identifies himself and you have already certified that they are genuine, they've been sent from KRA, then you're supposed to grant them access. And finally, notify details to the commissioner of any changes affecting the registered business. Now, a registered business is your business. Remember, you said individuals don't register for VAT, only businesses register for VAT. So the changes that you're talking about is, for example, a change of business name. If you rebrand and you change your name, you need to advise the commissioner that you've now changed your name within 14 days of changing that name. If, for example, you're operating a partnership and there is a change in the composition of the partners, you've either admitted a partner or maybe a partner has left the partnership, you're supposed to again inform the commissioner within 14 days. The other thing is, if the goods that you are dealing with have been changed, we say there are types of supplies, and we gave an example earlier where, for example, something was under VAT, it was taxable, but now it is exempt. You are supposed again to have the change reflected, and you are going to inform the commissioner of the changes. We have come to the end of our lesson. Today we introduced value-added tax, and we said that it is governed by the VAT Act, and we looked at the registration of VAT and also the meaning of value, as well as once someone gets registered, the rights and the obligations of the registered person. In our next lesson, we shall look at deregistration or cancellation of registration. That is, circumstances under which a taxpayer may be deregistered and therefore cease to charge VAT. Thank you so much. See you then.